If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year treasury, on your deposit products, in a currency that's depreciating by 7.5%, means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks, and I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities, and the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance 2 small silver companies. One, Pan American Silver at 50 cents, the other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold, because there was no love, there was only hate. The consequence of that is that that subset of silver stocks has done very, very well, up about 50-60% in the first, 7-8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes. In most industrial commodities, humankind has been underinvesting in productive capacity around those commodities for a very long time. So that even current levels of demand will, in the 5, 6, or 7 year time frame, exhaust our ability to produce them. We continue to underinvest in such commodities as copper, nickel, platinum group metals, nutrient materials like potash and phosphate, and oil and gas. So that if the pace of investment, the pace of productive capabilities doesn't increase, normal demand will overwhelm supply. The only reason that that wouldn't take place is if we had a synchronized global recession or depression. If we don't have a synchronized global recession or depression without the renewed vigor of Chinese expansion, but rather simply demographic trends, demand, even if it just held steady at today's rate, begins to overwhelm our ability to supply in a period as short as 5 years.
You know, I've got to say, for a guy like me, holding a decent position in gold bullion isn't just about finances. It's about peace of mind. At 71, sleeping well at night is a real luxury, and gold gives me that. I own a fair amount of gold bullion, and while it might sound boring to some, the comfort it brings is far from boring. I think it's important to emphasize this. Gold isn't just an investment. It's an insurance policy against the chaos of the modern financial world. Now, don't get me wrong. I'm not against silver. In fact, I love silver. I just don't own it in the form of bullion. My silver investments are in stocks, Why? Because historically, if you look at the latter half of a gold bull market, silver stocks often outperform everything else. There is no asset class quite like it. And let's face it, the number of legitimate silver companies out there is extremely limited. The market capitalization of these companies is minuscule compared to other sectors. What happens when this small silver market catches the attention of generalist investors? The answer is a flood of capital into a space that simply cannot accommodate it without dramatic price action. Imagine squeezing a large crowd through a tiny door. The pressure mounts and the results can be explosive. I've seen it happen multiple times in my career. In the 1970s, for instance, companies like Coeur d'Alene Mines went from 10 cents to $65 per share. It was insane. The pattern repeated itself during the bull market of the early 1990s. I was fortunate to finance two small silver companies, Pan American Silver and Silver Standard, at just 50 cents and 72 cents respectively. Several years later, both stocks had skyrocketed beyond $40. When I say silver stocks are the most explosive asset class, I say it because I've seen it firsthand. The gains can be truly life-changing, but you need patience, and most importantly, you need to enter the market before everyone else wakes up to the opportunity. I was loudly bullish about silver stocks at the end of last year and the beginning of this year, not just because I thought the fundamentals were strong, but also because there was so much hate toward them. I always tell investors, when everyone hates something, that's when you should start to pay attention. I watched the negativity play out across social media, and it told me that almost everyone who wanted to sell had already sold. The price action since then has proved it, up 50 to 60% in the first half of 2024 alone. To put it in numbers, I had about 2.5% of my portfolio in silver equities, and now that's grown to around 3.4%. Not because I added more money, but because those positions have outperformed almost everything else. Sometimes the smartest move is just to hold on and let the market do its thing. One of the major factors that can't be overlooked is the underinvestment in major industrial commodities. I'm talking about copper, nickel, platinum group metals, agricultural nutrients like potash, and of course, oil and gas. The world has been largely underinvested in these sectors for quite a while now. If we don't see an increase in productive capabilities, normal demand will inevitably outpace supply. Let's think about copper for a second. It's the lifeblood of the modern economy, from electric vehicles to renewable energy systems. Yet we are seeing very little new copper production coming online. The same goes for nickel and other critical materials. If we don't see an acceleration in the investment and production of these commodities, we are heading for a major supply crunch within the next 5 years. The only thing that could prevent such a scenario would be a synchronized global recession or even a depression, which, let's be honest, is not out of the realm of possibility given how the global economy is moving. But absent such a downturn, the writing is on the wall. Demand will outstrip supply, and prices are going to soar.
Which commodity do you think benefits the most from the Fed easing?
I think in the near term, and I define the near term as a year, gold. Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. This Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? That's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat-denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the US dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the U.S. 10-year Treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself, while tax is usually the largest component of every household budget. every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year treasury, on your deposit products, in a currency that's depreciating by 7.5%, means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Cutting the reference rate, cutting the Fed rate, cuts the yields on other savings deposits, while at the same time likely increasing the deterioration of the currency in real terms. And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market. I came into the business in the decade of the 70s, and the circumstance that confronts us now confronted us in 1968, when I was a little too young to understand it. But it was pretty clear, after having fought the war in Vietnam and the war on poverty, that we had more obligations as a society than we could service. It became fairly obvious, too, that we couldn't raise tax to cover the net present value of our obligations. So what we did in the period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price-controlled $35 an ounce, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II. Say 1946, all the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the US dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022.
If I had to pick the commodity that benefits most from a Fed easing cycle, it's gold, at least in the short term. In my experience, gold performs exceptionally well when people become concerned about the erosion of purchasing power. This recent 50 basis point rate cut from the Fed is very telling. We're told we have a great economy with a strong stock market and low unemployment. So why the rate cut? What are they seeing that they're not telling us? The reality is that the numbers the government puts out aren't exactly telling the whole story. They say inflation is running at 2.6%. But I think we all know that's a bit of a stretch. Every year, I do my own exercise where I look at the prices of the goods and services I consume, things like food, energy, and healthcare. And let me tell you, the government's inflation metrics just don't add up. When you exclude essentials like food and fuel, items that matter the most to the average person, it makes for a misleading picture. For most of us, inflation is not 2.6%, it's closer to 7.5%. So if you're getting paid 4% on a 10-year treasury, but the purchasing power of your money is dropping by 7.5% annually, you're actually losing money in real terms, around 3.5% per year. That's the kind of math that keeps me holding on to gold. It's not about the yield, it's about protecting the value of what I have. The recent rate cut lowers the return on savings while increasing the potential for inflation. And when people begin to realize that their cash is losing value faster than they can earn it, that's when gold really shines. It's a store of value, an insurance policy against both government incompetence and economic mismanagement. Let me take you back to the 1970s, which is when I first entered the business. I saw this play out firsthand. The economic scenario we're facing today is eerily similar to what happened back then. By 1968, after spending on the Vietnam War and President Johnson's War on Poverty, the United States found itself with more obligations than it could realistically meet. Instead of raising taxes to cover these obligations, the government opted for inflation. Over the next decade, the purchasing power of the US dollar dropped by over 80%. In the same period, gold went from $35 per ounce to over $800 per ounce. The writing was on the wall in 1968, but it wasn't until the early 1970s that people started to notice and react. By then, those who had invested in gold had already made their fortunes. I believe we are in a similar situation today. From 1982 to 2022, we've experienced an incredibly beneficial economic environment. The rise of American economic dominance, the strength of the dollar, and the growth of global trade created a period of relative prosperity. But like all good things, it had to come to an end. The excessive debt, the financialization of the economy, and the lack of real productive investment have brought us to the brink of another major crisis. As we move forward, we need to be aware of the forces at play and how they influence not just the price of gold and silver, but also our broader investment strategy. Whether you're looking to protect your wealth or position yourself for future growth, precious metals offer a compelling opportunity. While I have a sizable position in gold, my enthusiasm for silver stocks remains high, and for good reason. Historically, when the gold bull market hits its stride, silver follows suit, and it does so with gusto. We're already beginning to see the early signs of this. Despite the broader market skepticism, silver stocks have seen significant gains this year, and this is only the beginning. The relatively small market size for silver equities makes them highly susceptible to price spikes when capital floods in. Think about it like this. When generalist investors finally wake up to the potential of silver, they're going to rush in. The result? You'll have a small door with a large crowd trying to get through, and that's when the price action becomes parabolic. This is why, in my opinion, adding exposure to quality silver stocks before the rest of the market catches on could be one of the smartest moves you make. Beyond gold and silver, the world is woefully underinvested in the commodities we need to sustain modern life. We hear a lot about green energy, but no one seems to talk about how much copper, nickel, or lithium we need to make that vision a reality. The simple truth is that if we do not see significant investment in these areas soon, we are going to face severe shortages. But here's the twist. Silver is not just a precious metal, it's an industrial one too. As industries like solar power and electronics continue to grow, the demand for silver is only going to increase. Unlike copper, where production can ramp up if enough money is thrown at it, silver's supply is much more constrained. Most of the silver mined today is actually a byproduct of other mining operations, meaning it doesn't respond directly to price increases. This makes silver both a precious metal and a strategic industrial commodity, a rare combination that gives it a unique advantage. Let's talk about the elephant in the room: inflation. We've all heard the official figures: 2.6%, 3.5%, whatever they decide to tell us. But the reality on the ground is quite different. Most of us feel the pinch at the grocery store, at the gas pump, and when we pay our taxes. The true rate of inflation is much higher, and if you don't believe me, just take a look at your own expenses over the past year. Inflation is nothing more than the gradual erosion of purchasing power, and it's this erosion that makes gold such a powerful asset. Gold doesn't yield anything, and that's fine, because it's not supposed to. Gold's value lies in the fact that it doesn't erode. It's solid. When the dollar, euro, or yen loses value, gold holds its own. We're at a critical juncture in economic history. Central banks are confused, interest rates are unpredictable, and geopolitical tensions are rising. In this environment, precious metals like gold and silver offer a refuge, a way to preserve your wealth and sleep well at night. I don't know when the next major financial crisis will hit, but I do know that being prepared is far better than being surprised. We've seen how these stories play out before, in the 1970s and the early 2000s, and even during the 2008 financial crisis. The patterns are always the same. People ignore gold when times seem good, and then they rush to it when the truth about the economy becomes too obvious to ignore. My advice? Don't wait for the panic. The best time to buy insurance is before you need it. So whether you're considering adding a few ounces of gold to your portfolio or looking at the explosive potential of silver stocks, now might be the time to act. In a world filled with uncertainty, it's the tangible assets, the things you can hold in your hand, that offer the greatest sense of security. And remember, folks, it's not about getting rich. It's about staying rich. It's about protecting what you've earned and making sure that, No matter what happens in the financial world, you come out the other side in good shape. That's the power of gold and silver. That's why I hold them. And that's why you should consider doing the same.